one of the samples for insurance policy, right? Policy number, you will find the policy number. Policy number, where it will be written the policy number. Declaration page, I told you that it sometimes it might come with only declaration page as well. Homeowner insurance, this is the company name. New renewal, so renewal means in the type of, if your loan is a refinance, it could be renewal. If it's a purchase, it will be new. But sometimes renewal might not be, in the refinance, lender or borrower they don't want to renew the existing policy, they want to go for new, so that could be new as well. Or sometimes amendment date. Now it is very important. Amendment date will always be in the refinance. So let's say I have a property and I already have an insurance valid till, let's say, December 2023. Now, in the month of June, if I'm going for a refinance, right, but my property is already covered till December, then I don't want to go for the new insurance. Why should I go? I have already insurance form available, and that has enough coverage which covers the loan amount and property value, right? I won't go for a new, right, or to renew that insurance policy. So what I should do? The only thing that I need to change, that is the lender name. Previously, the lender was someone else. Maybe there is a possibility that previously I had a loan with US bank, and now this time in the month of June, right, I might be going for the Wells Fargo, right? So now I need to change that mortgagee clause over here. So I will ask the insurance company, please change the mortgagee clause, means amend this policy. No other change, no need to pay any money. Is that clear?
Yes, sir.
Okay, now the next is home insured and mailing address. So name insured and mailing address. So name insured means the person who is being insured and his mailing address. So here you will find the borrower name, right?
And his mailing.
And his mailing address. Very good. The mortgagee. Who is mortgagee? Lender, who is giving the loan. And this is the verbiage. ISAOA, ATIMA, I wrote up right below or in the side, or with mortgagee, his lender name and address will be mentioned. Okay. Here, this is the, it's the lender address, here lender name, and this verbiage. This verbiage means if tomorrow when this loan will be sold, means this loan file will be sold to some other investor need not to go to the insurance company and ask them to amend this insurance policy and change the lender name. No, this verbiage itself is enough that they will say, okay, it was already written that if this file will be sold to someone else, then they need not to go for the, they need not to change, they automatically become as insurance, they automatically becomes the insurance, successors, right? The full form of ISAOA ATMA means I means its successors and or assigns as their interest appear. This is the full form for the ISAOA ATIM. I for its, S for successors, A for and, O for or, A for assigns, as, T for there, I for interest, may appear. That is the full form of the ISAOA agreement. Means its successor if the lenders maybe may get acquired by someone else. Let's say the lender name is Indigenous Outlook. Now Indigenous Outlook acquired by some other company. Okay, maybe US Bank. So US Bank is the successor for the Indigenous, right? Because now Indigenous is the US Bank, right? So its successor means US Bank need not to go to the insurance company and change the mortgage clause. Because it's successor, so he's also covered. And or if assigns, so the assignment of mortgage. If Indigenous assign this file, right, to someone else, so they also become as their interest appears in this loan. Accordingly, they can claim against any loss on the basis of this one line. Are we good?
Yes, sir.
Very good. So, and again, never think that this is how all the time you are going to receive the insurance. Insurance companies are free, right? They are independent and their format is also independent. So you might receive this mortgagee clause with different name. You need to identify whether it's a mortgagee clause or not. Always it's not going to appear as mortgagee clause. It could change interest as well. It could change any other name as well. Good. Now the policy period effective from, it is for 12 months, means 1 year. But from when it is going to be effective? It is going to be effective from 12/6/2013. Expiration date, obviously 12/6/2014, right? Mostly you will see 12/5/2014. Right. Then AM standard, the time even written, right, for premises or dwelling. This is the residence address and this is the premises, means this is residence could be your mailing address and premises could be a different investment property or some other property. If you are taking loan on if this loan is against the primary home, you will find only one address, right here. But if you are taking this loan for second home or for your investment property, you will have a different address here. And that is what you always need to be careful about. Now the construction brick, not so very important. Here is the coverage. Coverage A, dwelling. This is what we are supposed to look at. Coverage, this is the 214,000. Now what you will look, loan amount. This 214,000 should be equal or more than your loan amount. That is what your job is to find here, to verify. This is the premium, right? But we won't go for only this premium. We will take the entire premium from the down. This is what you need to see. Then they have covered other structure, personal property, loss of use, right? Section 2, liability coverage, personal liability, medical payments and others. Basic premium. So this is all homeowner 3 special form, special provisions, personal property, replacement cost, loss settlement. Now it is very important this, but we have, let's say your home, sometimes you will see your coverage is less than, your home loan is 300,000. Your loan amount is 300,000, but your coverage is 240,000, 14,000. So you will first, at the first look, you are going to make out, oh, this coverage does not cover my loan amount. It should be either equal to 300,000 or more than this. But if here in the dwelling section, not every other right, if here it is written replacement cost covered, then we are fine, because they are telling that if your property get damaged, so whatever the amount that will occur to build the similar property, right, that is what insurance company is liable to pay, right? So what lender will be, lender is not going to get this money and recover their loan amount. If property is going to be there, they will ask the insurance company, okay, this is how much the amount that will require to build this property, right? They will build the property and will claim from the insurance company. So we are good. Then we need not to ask to increase the amount to 300, because they have given the replacement cost guaranteed replacement cost. Or sometimes you will see here the verbiage, right? It will, it could be increased replacement cost, and sometimes you will see the extended coverage extended to 125%, right? So that means if any situation occurs, then this insurance company will be giving 240. Where is my calculator? You can claim up to 125%. So what is your total coverage? 124, sorry, not 124, 214,000 into 125%. So you can claim till 267,000. If your loan amount would have been 250,000, 250,000, or 260,000, or even 267,500, we would be good. We won't ask anything. But in this scenario, do you think it is this extended replacement warranty or extended coverage is going to cover our loan amount? No, because our loan amount is 300,000 in this scenario. So we will ask them to increase the coverage. That insurance policy or HOI policy does not cover the loan amount. Borrower should, the coverage amount should be equal or greater than loan amount. That's what. Did you understand the concept? How to check the coverage and what are the replacement cost or extended warranty or extended coverage up to this point? Sometimes you might see 150%. In that case, you will increase this coverage to 150. 214,000 into 150%, right? It will become $321,000. So our coverage is only 300,000. So in this situation, what will happen? We know that this extended warranty or extended coverage is going to cover our loan amount. So we are good, right? Just give me 1 second. Sorry for that. Okay, so that is what the replacement extended warranty, extended coverage, right? Now, if you don't have replacement cost and if you don't have any replacement warranty or guarantee up to this percentage, in that situation, there is another document from where we can get, we should verify it, right? And that is appraisal document. These are few small things which you need to be careful about. It is not always we are going to just look at the coverage amount and we will say no, it's less than our loan amount, so bring more coverage. That is not the underwriter's job. That is why I'm telling you small concepts, right? From where you can save your borrower, you can save time. Otherwise, if let's say you are not looking at this, you are just verifying, oh, dwelling should be equal to or more than your loan amount. So you are going back to borrower and you have suspended the file. After 3 days, borrower comes back that okay, there is a replacement warranty up or replacement cost up to 125%. There is a extended warranty, right? Then again after 3 days you will or other underwriter or you are going to review this. That is something you always need to be very careful, right? Now, even if this situation doesn't occur, there is no replacement guarantee or warranty, there is no extended coverage, right? Then you will look for the appraisal document. In the appraisal document, when we will be going through appraisal, that time I will show you where you need to look for, or there is a cost approach. In the cost approach, there is one column that is CTBN. This CTBN means cost to build new. Means appraiser is going to give us, right, that if this property gets damaged or similar property, if required to be built as a new property, how much the cost will occur. So they are going to give us a cost to that. This is the CTBN. Let's say they are telling $210,000 means this property could be built, right? Could be built for 210,000. That is the cost for to build this property as a new property. So now again, when we checked, oh, if this property could be built for 210,000 and we have coverage till 214, so we are good, right?
Yes, sir.
Okay, and this why this occurs? Let's say if you are going to build a property, right? This property you wanted to build, it's a 2-bedroom, 2-bed, 1.5 washroom, right? And 1 kitchen, 1 maybe your living area. If you want to build this property in Shimla or maybe small town, somewhere in let's say in Mohali, Punjab, right? You can build this property for 210,000, right? Similar property, if you are going to build in Delhi, it will cost the same. Means same property will almost cost the same. Let's say it might cost you lesser or maybe 5,000 or 10,000 more or less. So let's say there also it is for 210,000. You spend 210,000 and similar property could be built there as well with the same specifications. But when you build this property in Mohali and in Delhi, do you think that if you are going to sell these property, are they going to remain same for the sale price? No, right? You know the Mohali, you could sell this property only for 300,000, where you can sell this property for maybe 1 million in Delhi, right? Because that is an urban area and Mohali is a suburban area, right? It's a small city. Delhi is a big city. So in the big city, similar property, if you have in Delhi, that could be priced or that market price could be huge. But similar property you could find in Mohali for a much lesser amount. Means the market value for the similar property in Mohali is going to remain very less. Did you understand the concept?
Yes, sir.
Right?
Yes, sir.
So that is why we are looking at CTBN, that is cost to build new, that it doesn't matter what is the property value. And according to property value, you are going to take the loan. But similar property, if could be built for 210,000 according to appraiser, then why we are worried about this coverage? Then we are good. But if there is no CTBN provided by the appraiser in the appraisal document, then obviously we will simply ask for the more coverage amount from the borrower, from the insurance company. Okay, good. Now, next we are going to check in this is the deductibles. Very important. I told you yesterday, right? So here they will tell you amount of deductible. So they are giving $2,000. We are not supposed to see whether how much amount they have given. However, it should not be excessive, that 5,000, 10,000 just for 200,000 coverage, right? It is going to remain mostly 500 or 1,000, and that is what the appropriate deductible file charge is. Then total premium. This is always going to remain the annual. Whenever it is given, we are not going to look at the top for the premium. We are going to consider the, we are going to see that, or we are going to consider the total premium. And then we will divide it by 12,699 divided by 12 months. So your monthly premium is going to be 699 divided by 12, 58.25% monthly, not percent, but monthly premium. This amount you are going to add into your proposed payment. Remember, proposed housing monthly housing payment. So proposed monthly housing payment, we are going to say insurance premium is $58.25. There will be P&I, and then there will be taxes. This is how we are going to review. Are we good? How to review the insurance?
Yes, sir.
Yes.
Very good. So this is how we will look for the insurance. There is another type of insurance. Evidence of property insurance. When evidence is going to come to us? Whenever we will have a purchase case, right? Evidence of property insurance. These are the borrower name. There are two borrowers. Right, this is the property address, policy number, HO3 policy type, policy effective date is 8/2019, 2020, right? Okay. Now this is your property information. I mean, this is the property which is insured. Year built, square footage, we are not very concerned. Additional interest, what does this mean? Name is indigenous, address in this city, build, type of interest.
Lender information.
Yes, this is mortgagee clause. Mortgagee clause, right? But mortgagee information is there, clause is not there. Clause means as is. What about that?
ISAOA information is not given.
Not given, right?
Yes, sir.
Now, definitely as an underwriter, we are going to ask for this verbiage, but it is not mandatory always. There is a possibility that lender is going to add this loan into their own portfolio. Means they are not going to sell this loan to anyone. They will, they will keep this file with themselves. But that is very rare unless we are working for a big investor, right? We need this ISAOA. So that will be let you know by your lender at the very start when you will start the file or when you will start your job. So you will get to know that whether this lender is just a lender and investor is different or not. Okay, but that is something we require. Sections and deductibles. Here is your deductibles, $1,000. This is your coverage, 145,000. You will always look for the, and this is your total premium, right? So that is how you will see different insurance companies are providing different type of formats, different type of verbiage. Okay, but we are not worried about the verbiage or headings or titles. Whatever we need to see, we need to see. So total premium, coverage, mortgagee clause, borrower name and address, policy number, policy effective date, period means, right, it should be valid. Policy type, no, policy type is not, we can make out what type of policy, and mortgagee clause, property address. These are the minimum information that we always will check. Okay, so these were the insurances, those for the single family relatives. Now we will look for the other type of insurance, that is certificate of liability insurance. Sometimes you might find blanket policy, sometimes you might find master policy, right? This is how it looks like. This is the producer, means the insurance company name. Okay, then insured. Insured means which building or which association is being insured. So mostly you will see here, in this you will always find borrower name, but here you will find the association name, right? Because here individual cannot take the insurance for entire building. So association is going to take, so you will see the association name. This is the association, right? Then these are the insurance company. Commercial general liability, claims made occur. Now here we cannot check the coverage. Whatever coverage we are fine, because right, it will be, it is for 1 million. See, our property value could be only 100 or 200,000. So we are not worried about the coverage, how much coverage they are taking for the entire building, right? We will only look whether this insurance include our property address or not. Okay. Policy number, policy effective date, obviously this is something we will look for, right? Policy number should be there, policy expiration date should be there. We are not worried about the coverage. We are worried about to see whether the verbiage written means, does this insurance sorry, does this insurance cover the walls in coverage, walls from inside, right? Let's see. Commercial general liability, general aggregate policy, project, automobile liability. Okay. Umbrella liability, right? Excess liability, occur, claims made, works compensation, any profitable mandatory, crime includes. There is no walls in coverage. Let's see. Description of operation, location, vehicle, condominium association, insuring agreement, original specification, single entity, walls in coverage. Did you find it? Now walls in coverage is written, so that means we are not worried about the HO6. We do not require HO6 for this home. Separation of inclusion included here, you will also find they have written condominium consists of 28 buildings and 224 units, but we will also require the address here, address of the property, right? Unless you have been specifically told by your lender that this is fine, but mostly 99% we require the property address here, our property address. Okay, separation of insured and included, so we are good. Walls in coverage here, we don't require the HO6 policy. In this here it's successors and assigns, right? Here your lender name will be written. Mortgagee clause always required. This is how we are going to check the master policy. Are we good? We are not, everything we need to check except the coverage. We are not worried about coverage. Now, since it is written that walls in coverage, right? Here. So we are not worried about to check the HO6, but let's say there is no walls in coverage. We didn't find it. For example, we didn't find it. Then we will require this HO6 policy. Again, name insured means your borrower name. It is going to remain same. We are going to check everything according to HO3 except the coverage amount, because we only need it should be, we will check that coverage should not be less than 20% of your property value. Everything else will remain same. Borrower name, their property address, effective date, 1 year policy period, right? Policy number, policy period should not be less than 1 year, right? Everything else will remain same. Only the 20% of coverage. Deductibles, we are supposed to check, right? Mortgage clause, we are supposed to check, right? Here it is written mortgage. That's the mortgage clause. Any question related to insurance? Because we are done with insurance. Okay, so if we are good, so this is what the insurance we are always going to verify in the for the proposed, whatever the amount we are going to consider in the proposed payment, right? Other than P&I, all other amounts, insurance, taxes, we always require the documentation. We always need to check the line by line document. Okay, that's all for today. We'll see tomorrow and we'll proceed accordingly.